Welcome to the Deep Dive, where we cut through the noise and get straight to the key insights. Today, we're putting on our Talk Tickers hats and digging into NextPlat Corporation's Q2 2025 earnings. These numbers came out before the market opened on August 14th, and management's framing this as a, quote, transitory reset, not a structural retreat. So our mission today is to really unpack the financials, look at their strategy, and see if that framing holds up for you.
Yeah, that framing is really crucial because the market reaction right after the release, it was definitely cautious, maybe even a bit somber, you could say. Even though there was clear evidence they controlled costs quite well, the market seemed really focused on the immediate revenue drop and the margin issues.
Right. It's a mixed bag then.
Exactly. So figuring out if this is genuinely just a reset or something, well, deeper, requires us to really get into the details.
Okay, let's do that. Let's start with those headline financials that got everyone talking. For Q2 2025, revenue landed at $13.24 million. That's a pretty big drop, 22.1% year over year.
Yeah, that's a noticeable decline.
But then, on the GAAP EPS side, it was a loss of $0.07 per share, which sounds bad, but it's actually a big improvement from a loss of $0.28 last year.
Quite an improvement there. And the overall net loss.
That also narrowed quite a bit, down to about $1.79 million loss from over $5.3 million loss in the same quarter last year.
Okay, so narrowing the loss is definitely a positive signal. Cost control must be working on some level.
Seems like it.
But the number that really jumped out, and what we need to unpack, is that gross margin. Got squeezed significantly, dropped to 21.8% from 34.5% year over year. That's a big move.
Wow, yeah. Over 10 percentage points.
And it wasn't just an overall thing. The healthcare segment's gross margin specifically plummeted to 19.9% from 35.2%. And even e-commerce, which we'll get to, saw its margin fall too, down to 25.9% from 31.6%.
So that combination, falling revenue and falling margins, that's what likely worried investors that.
I think that's exactly it. That's what spooked them initially.
All right, let's dig into these pivotal financials then. The healthcare segment seems like ground zero. It was the main reason for the overall revenue dip and that big margin compression. So what were the biggest factors hitting healthcare profitability so hard?
Well, it wasn't just one single thing, which makes it complex. It was more like a convergence of issues. First, they saw a definite drop in pharmacy prescription volume.
Okay, why?
It seems to be mostly down to changes in their relationships with providers and also shifts in patient flow. Think things like insurance network changes, or maybe providers just deciding to partner with different pharmacies.
Right, external factors impacting them.
Exactly. And second, there were some pretty significant changes impacting their 340B pharma service agreements. Just for context, 340B is that federal drug discount program.
Nice.
And for NextPlat, some of those relationships apparently moved to other partners. In other cases, the covered entities, the hospitals or clinics in the program, actually opened their own in-house pharmacies instead of using NextPlat. And they even had one covered entity leave the 340B program altogether.
Wow, okay. So changes in provider choices, entities bringing pharmacy in-house, and entities leaving the program. That sounds like, yeah, a triple whammy for that part of the business.
Yeah, it really does. And on top of all that,
there's more.
Yeah, you had the broader industry headache. Drug prices kept going up faster than the reimbursement rates were adjusting, so that just squeezed margins even further. It's a tough environment out there for pharmacies generally right now.
Okay, that paints a challenging picture for healthcare. Now, let's switch to the e-commerce segment. This one's kind of a paradox, isn't it? Because revenue actually increased there.
Right.
Driven by growth in recurring airtime, hardware sales, especially IoT stuff, apparently, and even some help from foreign currency. But despite that higher revenue, its gross margin still went down. What happened there?
Yeah, it's definitely a bit of a head scratcher at first glance. A mixed bag for sure.
Yeah.
So despite the revenue growth, the margin pressure seems to come mainly from one big thing. A key service provider airtime contract expired. That happened December 31st, 2024.
End of last year.
Exactly. So starting January 1st this year, boom, new, higher airtime costs kicked in immediately. It's like your cheap introductory cable rate expiring, you know.
Right.
Suddenly your bill is higher.
Right. That makes sense. It's the profitability per sale.
Precisely. And adding to that, the company also gave some temporary rate reductions to certain customers. Apparently, these customers were affected by some ongoing service interruptions. So good for keeping customers happy in the short term, probably, but it obviously dinged the margin per transaction too.
Okay, so higher input costs from the new contract and some temporary discounts.
Got it.
So we've got these revenue and margin headwinds on one side. But then, like you mentioned earlier, there's this really compelling story on cost control. Operating expenses dropped dramatically, $4.7 million this quarter versus $16.8 million same time last year. That's a massive reduction. How'd they pull that off?
Yeah, that is a huge number. And it wasn't just like cutting coffee budgets. A really big chunk of that decrease came from getting rid of significant non-recurring expenses from last year.
One-offs.
Exactly. Things like impairment losses they took on goodwill and other intangible assets. Plus, there were hefty legal and consulting fees last year tied to the Progressive Care merger. So pulling those out makes the year-over-year comparison look, well, dramatic. Some of it is just cleaning up the books from prior events.
Okay, so not all of it is sustainable operational savings then.
Not all of it, no. But importantly, beyond just those one-time items, they did also see real reductions in salaries and wages. That came partly from lower stock-based compensation. Some non-recurring grants had finished vesting, but they also just reduced their total headcount. So there are definite signs of trying to run leaner on an ongoing basis, too.
Okay, so a mix of one-time benefits and actual operational tightening.
Right. And management stress, they're still looking for more savings. Things like optimizing delivery processes, renegotiating with vendors, standard stuff, but important. And all this cost control helped their cash position. They ended the quarter with about $16.6 million in cash.
That cash cushion must be pretty helpful, especially with leadership changes. Which brings us to the management insights and their strategic outlook. They acknowledge the passing of their former executive chairman and CEO, Charlie, back in late May. And the interim CEO, David, he mentioned the team's doing a top-to-bottom review, focusing especially on those healthcare operations we talked about.
Yeah, and what's really striking, I think, is the immediate focus. It's not about aggressive growth right now. It's about stabilization.
Right. Fix the foundation first.
That's exactly the message. It underpins that whole transitory reset idea. Management is being really clear. Stabilize the core business, get the unit economics right, then think about scaling aggressively. Basically, fix the plumbing first, then scale. It's a direct response to the Q2 problems. Get each part efficient before you try to grow it.
Makes sense. Avoid growing unprofitably. And they've also dropped hints about some significant developments coming up really soon. Like within the next 60 days, what should we as investors be watching for in that pretty short time frame?
Okay, yeah, that 60-day window sounds important. They flagged a few specific things. First, expect some personnel changes. Managerial and supervisory levels, mainly in healthcare ops. And these aren't just shuffling deck chairs, it sounds like. They specifically mention bringing in new people with deep experience in community pharmacies in South Florida, focusing on long-term growth and strategy. So targeted hires.
Okay, strengthening the healthcare team. What else?
They also said they're in late-stage talks to open their first in-house pharmacy. This would actually support one of their current 340B customers, so it's a new business line for them, moving beyond just being a service provider.
Interesting. Owning the pharmacy itself.
Right. And third, they're boosting their focus on customer care. They've added dedicated sales and marketing people specifically for the 340B and long-term care markets. Apparently, the first hires are already out there, hitting conferences, finding prospects. So concrete actions there, too.
So new people, a new potential business line with the in-house pharmacy, and a renewed sales push. Those are definitely things to watch in the near term. What about looking a bit further out, longer-term strategic stuff?
Longer term, a couple of things stand out. One is China. They expect to get regulatory approval for their OPCO pet products there by Q4 this year.
Pet products in China?
Yeah. It could open up a pretty big high-growth market for them. This is interesting despite the general tariff issues that hit some U.S.-made products, like their Florida Sunshine brand. OPCO seems different.
Okay, so international expansion potential. Anything else?
The other big one is specialty pharmacy accreditation. They're aiming to get that also in Q4 2025. If they get it, that could be a real game changer for the healthcare side.
How so?
Well, it would open the door to completely new revenue streams, higher margin stuff like infusion therapies for HIV treatment or chemotherapy delivery, things far beyond just standard prescriptions.
Right, moving up the value chain in healthcare services.
Exactly.
Okay, let's shift gears slightly. Financial guidance. Did they give any formal revenue or EPS targets for the next few quarters?
No, they didn't issue any formal ranges.
Is that unusual or typical for a company like this right now?
It's fairly common, actually, especially for smaller cap companies, and particularly when they're going through a transition like this and, frankly, don't have a lot of analysts covering them closely. It often just signals they want to focus on hitting their internal plans, executing, rather than setting external expectations they might struggle to meet while things are still fluid.
Right. Under promise and over deliver, maybe. What about the share repurchase program they announced? Any action there?
Not yet. As of the earnings call, they hadn't actually repurchased any shares under the program, but they did explicitly say they expect to be active in the coming quarter. So soon.
Okay, so intention to start soon.
Yes, but they also added a caveat. They plan to be prudent with their cash because they have these other critical investments they need to fund, like maybe that in-house pharmacy build out, for example. So it sounds like a balancing act, returning some capital, but also funding the turnaround. They said they'll give updates quarterly.
Okay, balancing priorities.
Yeah.
Makes sense. One last point, and it's often a concern for smaller stocks. NASDAQ compliance. NextPlat got one of those minimum bid deficiency notices because the stock price dipped below $1. How are they handling that?
Yeah, that NASDAQ notice is definitely something investors watch. It basically means the exchange is saying, get your price back up, or risk delisting. NextPlat is closely monitoring it, as you'd expect. Their main plan to get back in compliance, it really hinges on everything we've just discussed. Improve the financial results by actually executing on those strategic developments, those 60-day things, the longer-term initiatives, and then communicating that value effectively to the market.
So performance is the cure.
Pretty much. Success breeds compliance in this case. They did mention they're prepared to use the extra 180-day grace period NASDAQ offers if they need it. So they have a backup timeline. But the clear focus is on delivering results and telling that story.
Okay, so wrapping this section up, what does this all mean for you, the listener? This quarter really does seem to fit management's narrative of a transitory reset rather than a structural retreat. You've got clear challenges, yes, revenue, margins, especially in healthcare. You also get serious cost discipline kicking in and what looks like a pretty clear roadmap to fix the underlying economics. It kind of feels like they realize they need to shore up the foundation before building higher,
That's a really good way to put it. It feels like foundational work is underway. And the key catalysts to watch over the next, say, 1 or 2 quarters are pretty clear now. We'll need updates on how those healthcare contracts are evolving, what's happening with prescription volumes.
Right, or the decline stabilizing.
Exactly. And on the e-commerce side, are they getting pricing back to normal? Are the network services stable now? And then, of course, those significant developments they promised within 60 days, especially that potential in-house pharmacy and the new healthcare hires.
Those feel like near-term make-or-break points.
They could be. Plus, keep an eye on progress towards that specialty pharmacy accreditation in Q4. And the OPCO pet product launch in China, also targeted for Q4. Oh, and definitely watch for any actual activity in that share repurchase program they talked about.
Of course, investing always involves risks. What are the main ones here?
Well, with a stock like NextPlat, the thin liquidity is always a factor. It just means the stock price can be more volatile. Small amounts of buying or selling can move the price significantly up or down, and those challenges in China, like tariffs on some U.S. goods, are still out there, even if OPCO might sidestep them. It's a complex market.
Okay. And any broader market context?
Just briefly, it's maybe worth noting that small-cap stocks in general, like those in the Russell 2000 index, have shown a bit more strength recently. So if NextPlat can deliver on its specific plans, there might be some market tailwinds helping them out, potentially amplifying any positive news.
All right, that brings us to our This Is Not Financial Advice segment. This is where we float an outrageous but plausible trade idea, just as food for thought, not a recommendation. So, picture this setup. Here's a company trading under $1. It's got that NASDAQ notice hanging over it, and it just reported a sharp drop in revenue. The market clearly reacted negatively at first. Most investors, they probably run screaming right, seeing only risk.
Absolutely. The knee-jerk reaction is definitely negative, avoidance. But what if that very distress is the opportunity? So the play here, purely speculative, remember, could be to consider a long position in NextPlat.
Okay, that sounds bold. What makes it outrageous?
The outrageous part is betting on a turnaround at all in a company facing these kinds of headwinds. With a sub $1 stock price and a delisting notice, it goes against the grain.
And the plausible part, why isn't it just crazy?
The plausible angle lies in the clarity of the strategy and what management is saying. They seem very focused on fixing the fundamental problems, not just papering over cracks or chasing growth for growth's sake.
Right, the fix the plumbing approach.
Exactly. Plus, they've already shown significant cost discipline by narrowing that net loss. That's tangible progress. And crucially, they've specifically flagged these significant developments coming within 60 days. Those are concrete, near-term potential catalysts catalysts that the market can react to.
And the buyback intention adds another potential positive trigger.
Precisely. Management explicitly said they expect to be active on the share repurchase front this quarter. So you put it all together. A clear turnaround plan focused on fixing the core, real cost cuts already achieved, specific near-term news potentially on the way, and the possibility of buybacks supporting the share price. That combination could spark a reevaluation of the stock if they execute.
So it's basically a bet on management actually delivering on these near-term promises.
It's absolutely a bet on execution. And a bet that as these developments unfold, if they do, market sentiment will shift. You'd be watching those 60-day announcements like a hawk and listening closely for any updates on buyback activity.
Okay, an interesting, if definitely speculative, thought exercise there. So let's recap the whole deep dive. NextPlat Corp is, well, navigating what they're calling a transitory reset after a tough Q2 2025, marked by real challenges in revenue and gross margins, particularly in healthcare and e-commerce.
Right. But countering that, the company has shown strong cost control, and they do seem to have a clear strategic plan focused on stabilizing first, then growing. Plus, those significant developments they teased are expected very soon, which adds an element of near-term anticipation.
Absolutely. The next few months look pretty critical. We'll see how well management executes on this roadmap and whether this truly turns out to be just a reset or something more challenging. Remember everyone, this deep dive is purely for informational purposes. It is definitely not financial advice. Thanks for tuning in to The Deep Dive. We hope walking through NextPlat's earnings gave you some valuable insights. Until next time, stay informed.